From what you know, and then we'll formally get into the slides. What is valuation? What's the point of it? What's the purpose of it? Anybody?
Compare a company to other competitors.
Compare a company to other competitors for what purpose?
Investing.
Say again?
For investing.
For investing, yeah. And then what's comparing the company aim to do?
See if the market is overvaluing or under.
Figure out the market price. If the market price is overvaluing the entity, right? What other purposes are it for? So to determine the market price.
The price if it were to sell.
The price if you were to sell the business.
Or some part of it.
And how do you approach the value of a business? How do you value a business?
On their ability to generate some type of cash flow.
On their ability to generate some type of cash flow. So on cash, right? You value business on cash. What's the technical term for valuing business on cash?
DCF.
DCF, discounted cash flow, right? There's a discounted cash flow. Why do we discount cash? That's a common investment banking interview question that I've kind of answered this morning. But why cash? Why are we discounting cash?
That's their ability to generate enough profit to pay their interest and expenses.
Like why? Right, but like why? Yes. Like why is it a discounted cash flow analysis, not a discounted net income analysis? Which some industries you can do that, but why is that the convention?
If you're not getting cash inflow, you're not going to be able to pay your bills.
Yeah. So if you're not getting cash flow, so to an investor, typically cash is really a better representation of what the business is actually producing, right? The investor's return in a DCF analysis is determined by what? I don't expect you guys to know, but maybe somebody knows, and this will just generate discussion, so don't feel nervous if you're like, oh, I don't know. Generated by what? Weighted average cost of capital, the discount rate, right? So in a discounted cash flow, you project out cash flows, and then you discount those cash flows back at a rate that's supposed to be representative of the expected return to an investor. And we'll talk about all this, right? So that's based on cash, because if an investor puts cash to a business, he expects cash back. Right? You can't really do that in net income, because net income isn't directly representative of the cash coming into a business. What are other ways to value a business? So there's taking the company's cash flow and discounting it back. That's a representation of the company's value. What are other ways? Comps. Comps are what Paul was saying before, taking a company's profitability and comparing it to other companies. How do you compare these companies?
You need to find
Multiples.
You need to find companies too that have similar core operations.
You need to find companies that have similar operations, and also you have to look at those companies' multiples, right? What's another? So multiples. That's an important thing we're going to talk about today. What's another important method of valuation? A third.
Precedent transactions.
Precedent transaction. What are precedent transactions?
I think if you're going back and you're looking at historical sales prices of like a business entity, or a specific group of assets, and you're basing that valuation today based on the historical transaction itself.
Well, you got part of it right. Go ahead, Paul. Sorry.
I think is how much a similar company has been sold for.
Yeah. So it is based on transactions, based on how much a company's been sold for. In other words, you're looking at multiples that represent purchase prices of transactions. So if we're looking to value Walmart, the precedent transaction analysis will analyze other companies similar to Walmart that have been acquired, and what price did they pay for it. And the price paid would represent the value of that company. So if other people are paying $10 billion, or I guess Walmart's like $250 billion, for large retailers, then Walmart could be valued around that $250 billion range. That's more or less the idea. But you wouldn't look at absolute values, you'd look at multiples. Actually, in all these analyses, it really comes down to multiples. So I want to talk about multiples and what they mean. So in short, there are three major methods of valuation. There's the comparable companies analysis, the discounted cash flow analysis, and the precedent transactions analysis. This is section 4 in the slides, and we'll go into this in a lot more detail. But what I want, and we'll talk about each one of those in more detail, and we'll analyze those from Walmart. But we first have to build a model on Walmart. What I want to talk about today is the results of these analyses are multiples. I want to talk about what the multiples are and what they mean. Right? So how is the value of a company represented? Even if we didn't do a discounted cash flow analysis, a transaction analysis, or a comps analysis, what's the value of Walmart? What's the value of Walmart? How is it represented? Stock price. Who sets that?
Market.
The market. The investors. So there's a market value of a business. What's another way of establishing the value of a business?
I mean, the books.
Book value. The book value. Well, what's the book value? What is the book value?
Yeah.
The value of the equity, the balance sheet, right? So the balance sheet, we didn't have our lesson on the balance sheet yet, but the formula of the balance sheet is you have assets, you have liabilities, and the assets minus the liabilities equals the shareholders' equity, right? And we talked a little bit about, we used this in the previous example today, but an asset is like cash, accounts receivable, property, right? Assets are resources who's expected to provide some sort of future economic benefit. That's the definition of an asset, right? A liability is a debt or obligation, something you have to owe to somebody. And then equity is the value of the business to the shareholders, to premium shareholders, etc. Right? So the book value is really represented by the shareholders' equity of the business. The value of all the company's assets less the liabilities that are associated to those assets. That's the net value of the business. That's the value of the business as written up by its books. That's the book value of the business, the book value. So if you think about the balance sheet formula, and you think about the book value of a business, there's the shareholders' equity, right? There's, that was bad, there's liabilities, and the shareholders' equity plus the liabilities equals assets. So I'm just re-representing the standard balance sheet formula that you should memorize, right? If you take the value of the shareholders' equity and add the value of the liabilities, you get the value of the company's assets, right? You can find the value of the shareholders' equity by looking up the balance sheet, the value of the liabilities by looking up the balance sheet, and you can also find the value of the assets by looking up the balance sheet, or you could back calculate into one of those by using this formula. Right? So let's say we have a company that has a shareholders' equity value of 5. Let's say it has liabilities of 4. It should have an asset value of 9. Right? Easy. Numbers you can look up on the balance sheet. But the market value has a different way of thinking about it, because the market value is current and is based on value determined by the investors. It's based on the stock price. Market value you can think about in relation to the company's shareholders' equity. Shareholders' equity is the value of the business as determined by its books, right? By the value of the assets on its balance sheet, by the value of the liabilities on its balance sheet. But it's not current, and it has no indicator of what investors believe that the company should be worth, right? So the market value is based on the market capitalization, which is defined as the dollars per share times shares outstanding. That's the market cap. And the market cap typically trades at a premium to the shareholders' equity. Typically, unless the company is very poorly valued right now. So let's say this company that has its book value of 5 trades in the market at 7, at a premium. So even though you look up its book value and its shareholders' equity is 5, if you go to its market cap, it's 7. Why is it 7? Why is it a little bit higher? Because investors are trading it. Maybe investors expect growth in the business. Maybe investors are not valuing it properly. Maybe investors are valuing it properly. It depends. This is all the questions we're going to ask, and will be easier explained when we apply this to a real situation. But typically, the value, the market value of the company trades at a premium to the book value. So what happens, and we do this quite often, if we take the market value, if we go to the balance sheet, we look up the liabilities, which we said were 4 on the balance sheet. What happens if we add the market value to the liabilities? What happens? What do we get? What's our results? Say again? It's more than
Assets.
the asset value. More, you mean more than this? A little bit greater than this. It's 11, right? It's 11. But the idea is it's the value of the assets, but it's the implied value of the assets determined by the investor. So we're kind of backing into the current value of the assets. Why do we care? Because, well, what are the assets? The asset is the PP&E, let's say, the property of the business. In the balance sheet, where does the property of the business come from? Well, it's the appraised value, maybe the purchase value, but that value should theoretically change as investors start trading the stock. So this is where it becomes difficult. So how do we figure that implied value of assets? How do we figure out what the implied value of assets are? Well, this is kind of what's in debate and where valuation theory comes through. Well, if you take the market cap and add back the liabilities of the business, this is technically the implied value of the assets. Assets trade at a premium. The premium could just be the fact that the old asset value and the book value isn't the same price it was. The value's increased. It could be maybe the impact of the significance of the brand of the business, intangible assets. We'll talk about all this stuff when we get into book value. But generally, this bar represents the implied value of the assets. Right? What does the investor say the assets are worth? Forget the book and forget GAAP. Two different ways of thinking of valuation. Right? Book and market.
Would that create something like goodwill?
Yeah. We'll talk about goodwill and M&A. Yeah, goodwill is intangible assets. Any reason why the value of the assets are greater than what the book says is goodwill, but we'll break that down into different segments. So, in reality, though, when you take market cap and you add liabilities, we really don't take market cap and add the total liabilities. We take market cap and we add a subset of the liabilities, short-term debt plus long-term debt less cash. That's what we add. It's a subset of the liabilities, right? When you take market cap and you add short-term debt plus long-term debt minus cash, you basically get what's called the enterprise value, right? It's the implied value of the assets, but it's the enterprise value. What difference does that make? What difference, what significant change did I just make when I changed liabilities to this subset, which is short-term debt plus long-term debt minus cash? I get a little complicated here, and we'll do this more formally in the valuation class, but I'm just kind of seeding this to you. Well, let's draw out this balance sheet formula. Assets minus liabilities equals shareholders' equity, or let's be more specific. So what are major components of assets? Even though we didn't talk about the balance sheet yet, what are major components of the asset section of the balance sheet? At least you can kind of make some up based on the examples that we've been going through. What are major assets? Cash. Cash is one. What else? Accounts receivable. Right, we've been dealing with that a lot.
Inventory?
Inventory. One other major one.
PP&E.
PP&E, at the property of your business. PP&E. Those are big, the major assets generally. There's some exceptions, but cash, AR, inventory, PP&E, major assets. What are major liabilities? Accounts payables. What else?
Current portion of long-term debt.
Debt. Long-term debt. And let's say short-term debt. Let's keep it at that for now. Major liabilities. Accounts payable. Oh, maybe accrued expenses, but whatever. Keep it simple. Accounts payable, long-term debt, short-term debt. So, really, when I break this down, I have shareholders' equity plus liabilities equals assets. Or shareholders' equity plus accounts payable, long-term debt, and short-term debt equals the value of my cash, AR, inventory, and PP&E. That's what that is. That's the balance sheet formula. Right? We can rewrite that as shareholders' equity plus, right, that's the shareholders' equity section, plus accounts payable. I'll add accrued expenses. Accrued expenses plus short-term debt plus long-term debt equals, right, these are shareholders' equity, liabilities equals the assets, right, equals the value of cash plus AR plus inventory plus PP&E. Assets. That's the standard balance sheet formula. Right? We'll learn about this more when we do the balance sheet. Right? That's this. Just drawn out. You take shareholders' equity, you add liabilities, you get assets. Take the components of shareholders' equity, add the components of liabilities, and you get assets. Right? But what I'm trying to illustrate is, let's take a look at the market value version of this, where you don't take shareholders' equity, you take market cap. You take market cap, and you add liabilities. You still get the value of the assets, but this is the implied value of the assets as determined by the investor. If that's the idea. But you'll soon learn, and we will see, that in valuation, we take market cap, but we don't add every single liability. We only add the net debt, the debts and obligations. Forget about cash for a second. We'll only add debt. What happens if we only add debt? What are we left with on the other side of the equation? Well, we can do some simple algebra and subtract AP minus AE from this side of the equation, and subtract AP minus AE from this side of the equation, right? So you're taking market cap and adding just short-term debt and long-term debt, right? You take market cap, you add just, can people see down there? Yep. You add just short-term debt and long-term debt, and you're left with cash plus AR plus inventory plus PP&E minus accounts payable minus accrued expenses. Now, we didn't talk about this yet, but we'll talk about this next Thursday, that your accounts receivable plus your inventory less AP less AE, or basically all your current assets less your current liabilities, this is all working capital. This is something called working capital. So I'm going to simplify this formula, and I'm going to say this is basically equals cash plus working capital plus PP&E. I could have written it out long form, but I'm simplifying. Cash plus working capital plus PP&E. That's this. Right? That's this, right? This is the market cap plus short-term debt, forget cash for a second, plus long-term debt. If I just add short-term debt plus long-term debt, not all liabilities, I'm left over here the implied value of cash, working capital, and PP&E. We're approaching the important piece of valuation. Why is that important to me? Why is just cash, working capital, and PP&E important to me versus all the assets? Yes, Paul.
Because those are the things that cash is already cash. PP is something you can sell and get cash from, and working capital is what your business is providing.
Working capital and PP&E, yeah, are what your business is providing, is really the key. So cash is the one exception, but basically it's working capital and it's PP&E, or here in this formula, it's working capital and it's PP&E that is what will drive future profitability in my business. It is the operating assets of business. So in valuation, what you really want to try to achieve is the value of business operations. That's key. So that being said, cash arguably is not part of that. Cash, like you said, cash is cash. It sits on your balance sheet. It's really not there to generate more operations. I mean, you can use cash to buy stuff to generate more operations, but it's really these assets that are generating operations in the future. And that's why what we will do is we'll subtract cash. I want cash out of the right side of the valuation. I want to be left with just the operating assets of the business. I'm going to subtract cash from this. I'm going to subtract cash from this. So what does that do? That eliminates cash here. And I'm left with market cap plus short-term debt plus long-term debt minus cash, or net debt. Market cap plus net debt, right? So if I apply this here and I say, all right, well, let me take market cap and add short-term debt plus long debt minus cash, short-term debt plus long debt minus cash. Then on this side of the equation, or here, is the implied value of just working capital and just PP&E. It's the implied value of the operating assets of the business. That's enterprise value. Right? That's what enterprise value is supposed to be. It's your market cap plus your net debt. Why is enterprise value what it is? Because it's supposed to approach just the value of the operating assets of the business. Why is that important to an investor? Because it's just the value of those operating assets that will continue to produce in the future. And we'll see this time and time again when we look at valuation in different angles. Discounted cash flow, for example. We didn't learn this yet, but the discounted cash flow is not your total cash. It's cash just from the operations of the business. What cash is being produced just from the operations of the business? Why is an investor only concerned about cash from just the operations of the business? Because that's what's going to continue to produce cash in the future. So from a banking perspective, enterprise value is important because it measures the implied value of the operating assets of the business just for the investor, just based on shares outstanding. That's an important investment banking interview question. They'll ask you, what's enterprise value? And you're going to say, because you've memorized it, enterprise value is market cap plus net debt. And they're going to say, well, what's net debt? And you're going to say, it's short-term debt plus long-term debt minus cash. And they're going to say, well, why minus cash? Why minus cash? And the answer is because you want to value just the operating assets of the business. And when you take market cap and you add back short-term debt, long debt minus cash, you're left on the other side of the equation, the implied value of just the operating assets of the business. That's the idea. So we're going to go into this in complete detail when we talk about valuation. I'm just trying to plant the seed, right? It's important to start thinking about that because for your comps, there is market value and there's enterprise value, and you need to at least know enough to recognize those terms and recognize how to apply them. Market value is the market cap, is the shares outstanding times the price per share. That's real simple. Enterprise value is the market value is the market value plus the net debt. Very simple. So when you see enterprise value, you have to take the market value, and then you have to add, just look it up on the balance sheet, the company's short-term debt plus long-term debt minus cash. So if there's any takeaway from today for now, because we're going to have a whole 3 weeks on this stuff later on, just be able to recognize that market cap is just taking the company's share price from Yahoo Finance or whatever, multiplying by its shares outstanding, and then enterprise value is that market cap plus taking the short-term debt plus long debt plus minus the cash, and you can look that up on the balance sheet because you'll need to do that for the comps. Any questions on that? Yes, Paul.
But the enterprise value has nothing to do with the price that an investor would pay for the company.
It should approach the price that an investor would pay. I wouldn't say it had nothing to do with it, but the investor can argue against that, can increase it, can decrease it. There's other components to enterprise value that an investor might be skeptical of. Maybe that's what you're saying.
Because if I'm buying shares of a company, well, I'm not going to buy 100% of shares, but I'm buying at the market value, right? Because I'm buying shares at the market value.
Yep, that's right.
Which is much lower, well, could be lower than the enterprise value.
Yep.
So why should I pay for the enterprise value when I can simply pay for the market value?
If you're investing in a stock, and this is why if you look at equity research reports, stock prices are based on equity price per share. That's fine. But if you're buying a company, leverage buyout, if you're buying a whole business, you're concerned about this because this is what's going to produce cash that will give you your money back in the future. But if you're just investing in a stock, you're concerned about is the stock going to increase, is the stock going to decrease? These operating assets producing cash, that's not going to go into your pocket. So two different perspectives.
Okay.
That stuff we'll learn in the 3 weeks evaluation over time. How you use it as a tool for different reasons, we'll learn that. So you make a good point, but that's to come. For now, it's just generally understanding the terms, generally recognizing the terms. At a first cut, and we'll do this whole lesson all over again, and you'll have a deeper understanding once you have built the model and understand the basis of and the function of each. So really, there's market cap, and there's enterprise value, which is market cap plus net debt. And net debt is short-term debt plus long-term debt minus cash. This could get more complicated, and we'll expand on it, but this is just the basis. Now, for your comps and really in valuation, I talked about multiples. We didn't get to multiples yet. So what are multiples? Well, multiples is based on these metrics, right? There are market multiples, and there are enterprise value multiples. Well, what are the difference? Because when comparing companies in valuation, you can't just look at the absolute values. If I look at a company that's worth $10 million and I compare it with a company that's has a market cap of $10 million, or a company has a market cap of $20 million, how do I know which one's better? Right? You want to look at the value of the business in relation to some income statement operating metric. That's what a multiple is, right? These numbers are absolute, and until you compare them with something, will these multiples become comparable. So in other words, there are multiples called market cap to net income, right? Market value to net income. Or there's a multiple called enterprise value to EBITDA. And you can figure out the mechanics of that, right? You're just taking the market cap and you're dividing it by net income. Or you're taking the enterprise value and dividing it by EBITDA. If there's any takeaway, at least to be productive when you're interning, it's if you're asked to do comps, how do you get market cap? Look up the share price, multiply it by shares, divide it by net income. How do you get enterprise value? Take the market cap, add short-term debt plus long-term debt minus cash, and then divide it by the company EBITDA. You should at least know how to do that. But I want to make sure you understand why you're doing what you're doing and what does it mean. So market cap or market value multiples compare the market value of a business to some underlying operating or balance sheet data. Enterprise value multiples also compare enterprise value to some operating data. But the data that you compare it to, the denominator, is different, and there's a reason for that. You notice that enterprise value is compared to EBITDA. Enterprise value is not compared to net income. Why? Enterprise value cannot be compared to net income. Why do you think that is? It includes the debt, right? So in other words, enterprise value is market cap plus net debt. EBITDA is earnings plus interest. Both metrics that are before debt or interest, right? Market cap is based on the stock price, which is theoretically based on the value of the business after lenders have been paid. So the net income is a metric after interest has been paid. So in other words, if you're looking at the value of a business after lenders have been paid, you can only compare it with an underlying metric that's underneath the interest expense line on the income statement. If you're looking at a metric that's above the interest expense line, such as EBIT or EBITDA, you can only compare it with enterprise value because this adds back the value of the lenders. Just another thing to memorize. So in other words, multiples exist. The most common multiples are market cap to net income, price to earnings, enterprise value to EBITDA, enterprise value to EBIT, enterprise value to sales. So when you're doing your comps, you should know to recognize and calculate those line items. These give you multiples. Multiples mean nothing when you're looking at them on an absolute basis. They're only helpful in comparing against other companies, in checking is one better or worse than the other. Better as a loose definition. So in other words, if company A has a PE of 5 and company B has a PE of 6, what's better? Right? Is the company is the company with a PE of 5 overvalued or undervalued in relation to its market? Well, you have to compare that with several companies, right? Not just one. So if the company has a PE of 5, and other companies within its industry has a range of maybe 7 to 10. So if the company analyzing is 5 times EBITDA, and the others has 7 to 10, that could mean that this company is undervalued. That's the idea. That's how you compare multiples. Right? That could mean that, or it could mean that the whole industry is overvalued, but we'll look at that when we formally go into valuation. If this company has a PE of 20 and its peers consistently have a PE of 7 to 10, that could probably mean that this company is overvalued. Right? That's the point of multiples. Right? So multiples, if you stand alone and say, well, company A has a value of 5, a PE of 5, it means nothing. It really means nothing. You have to compare that to its peers to determine, is it producing higher or lower than its peers? Right? And you have to look at multiples because looking at just the absolute market cap or enterprise value doesn't mean anything until you compare it to its operations. Any questions on that? To illustrate this further, let's say you have a set of comparable metrics, PE, enterprise value to EBIT, enterprise value to EBITDA, etc. And you want to think about, well, which metrics are better for me to look at? Price to earning, net income, enterprise value to EBITDA. How do you know which metrics to look at?
Depends on what you're trying to do.
Depends on what you're trying to do. What do you mean depends on what you're trying to do?
Well, I mean, I think kind of like Paul's example, if you're looking to just invest in a company, it might be okay to look at the market cap multiples. But
Yep.
if you're looking to purchase the whole company and its assets, it'd be better to look at enterprise value multiples.
Right? That's right.
Because you're looking to get a better indication of how they're operating if you go with the enterprise
Right.
value multiples.
I'm going to give it also relates to the industry, what you're doing. I'll give you a very basic example that'll hopefully help illustrate a little bit about why multiples are used. And in my opinion, it's better for you guys to fiddle with them and play around with them and struggle with them. And we'll get to week 3. And then we'll talk about what it means so you have at least a basis rather than just talking about all this theory. We'll talk a little bit about the theory and then we'll go back into it once we have more modeling expertise. Let's say we're a delivery business and we're looking to acquire another delivery business. Let's say we're UPS, right? Delivery company looking to acquire another one in the New York area. And let's say that there are 2 that we're analyzing. Company A is maybe based in Manhattan and company B is based in Queens, something like that. And let's say company A has revenue of $10,000 or $10 million. Right? Let's say they have COGS of 5,000 and OPEX of 1,000. So roughly an EBITDA of 4,000. So from an operations perspective, they're kind of performing the same. But now let's say they have two slightly separate business models where company A is based in Manhattan, so they have to kind of build out a warehouse in New Jersey or something, and they've raised a lot of debt to fund that warehouse, let's say. And so they have depreciation on that warehouse. They have D&A of $3,000. And let's say they have interest expense because they've raised debt to build that warehouse. Interest expense is $1,000. Forget taxes for now. Then it comes to zero. Let's say company B, different business model. Let's say it's a one-man kind of show, right? And he doesn't need a warehouse. He keeps everything, I don't know, in his house, if that's believable. He has no depreciation. He has no debt, no interest. So forget taxes for now. His net income is $4,000. So the point is here, if I'm UPS, well, if I'm a stock investor, I'm concerned about PE, right? If I look at the price and divide it by the net income, this is going to have a lot larger value than this business. It's going to be divided by zero. Zero is going to look very poor. So I want to look at PE. But if I'm looking to buy these businesses, and let's say I'm UPS, I don't care about the warehouse. I don't care about the debt, because when I buy the business, I'm going to sell the warehouse. I'm going to wipe out the debt. I want to know customers, the routes that he's driving, the costs associated with those routes. If I do that, I'd look at EBITDA. I want to look at EBITDA because this is before the impact of the debt on the business, the impact of the depreciation. This is just telling me how is he making deliveries and how efficient is the response from his deliveries. That's the value of EBITDA to an investor acquiring a business. And in that case, both these businesses are producing pretty much the same. This is the benefit of looking at EBITDA and treating EBITDA as a clean and consistent measurement, because it's void of all the other impacts to the business that are related to debt and related to depreciation that's not directly related to operations. So in some situations, you might be more concerned or better concerned about just the operations of the business. And that's why in a lot of times in valuation, we're only concerned about EBITDA. We're only concerned about the operations of the business. And if you're comparing using just the operations of the business, the underlying metric, you cannot compare this to net income. Sorry, you cannot compare this to market cap, because market cap is an effective value of the business after lenders have been paid. You have to take market cap and add back net debt. That's enterprise value. And that's why enterprise value to EBITDA is a common metric. So we'll drill into this in a lot more detail. A very simple example, right? But I want to at least give you a little piece of why you're starting to do comps, right? But at least for now, you should have a little bit of an idea as to how to put together historicals in an income statement, how to make projections in an income statement, even if it's very loose, jumbled in your mind. I'm going to send you guys another practice model if you feel like you need more practice. I would encourage you to email it to me over the weekend, and I can take a look at it. And if this will be a good test for you, if you guys are really lost, I'm going to set up one-on-one sessions to help you out. I want to see where you're at. On the income statement, it's a real simple income statement. This is good if you're a smaller group, so I can do this with you guys. With 50 people in the summer, I can't do this. So I'm going to send it to you. Take time over the weekend. If you feel like you can only get to EBITDA, I can see where you need some extra help. If a bunch of you guys are at the same, then we'll do breakout sessions in the afternoons if you feel like you need it. But, focus on the income statement. With whatever that you're doing, at least you can build a historical income statement, you can build projections, and you can at least start layering in enterprise value, market cap, and multiples. And if you're stuck in that kind of stuff, feel free to email me. And then you have, Luis and Kevin and all those guys. And I don't know if Jennifer's been in yet, or Walter that you guys met on the first day. I don't know, but all those guys as well. Do you have any questions?